This video is an Uncovered Japan company research report on Internet Initiative Japan, ticker 3774. IIJ was Japan's first commercial internet service provider. Today, it is an independent, full-stack operator of corporate digital infrastructure, spanning networks, cloud, security, system integration, and mobile services. The central investment question is whether owning the physical layer can keep supporting double-digit growth and a roughly 10% operating margin, as IIJ invests heavily for the AI era. The report scores IIJ 15 out of 20, 5 for growth, 2 for value, 5 for macro fit, and 3 for supply and demand. 5-year revenue and operating profit growth are both around 11%, while return on equity is in the mid-teens. The catch is valuation. At about 22.9 times forward earnings and 3.6 times book, the market already expects IIJ to keep executing. This is a quality story, but not an obviously cheap one. What does IIJ actually sell? Its customers can buy internet connectivity, wide area networks, IIJ's own cloud, managed cybersecurity, system integration, and mobile services. IIJ MIO serves consumers, while its technically demanding full MVNO capability supports corporate Internet of Things use cases. The important point is that these services are stacked on IIJ's own backbone and data centers. A bank, government agency, or enterprise can hand a complex environment to one technically led operator, instead of coordinating several vendors. The financial record supports the operating story. From fiscal 2022 through fiscal 2026, revenue rose from about 226 billion yen to 345 billion yen. Operating profit increased from roughly 23.5 billion yen to nearly 35 billion. Both lines compounded at around 10 to 11%, showing that growth has not required IIJ to surrender its overall margin structure. IIJ reports two segments, but network services and system integration account for more than 99% of revenue. Inside that broad segment, network, cloud, security, and mobile subscriptions create a recurring base. System integration projects are lumpier, but successful projects often convert into ongoing operations and maintenance revenue. The tiny ATM operations segment barely affects sales, yet its high margin adds an unusual pocket of profit. IIJ's moat combines ownership and neutrality. Because it owns infrastructure that many integrators rent, more of the economics remain inside IIJ. End-to-end control also improves reliability and makes fault resolution simpler for mission-critical customers. At the same time, IIJ is not captive to one hardware maker or hyperscaler, so it can credibly recommend a mixed cloud architecture. Once the company is embedded beneath a customer's systems, the operational risk and cost of switching become meaningful. IIJ has funded growth while maintaining a sturdy balance sheet. The equity ratio has stayed around the mid-40s, while return on equity has remained mere 15%. That combination matters because data centers, network capacity, and graphics processing infrastructure demand real capital. The company is not asset-like SaaS, but it has so far produced software-like recurring economics on top of owned physical assets. The key near-term tension is cash flow. Operating cash generation remains positive, but free cash flow fell sharply as IIJ increased investment in data centers and computing capacity. The report interprets this as an investment cycle signature, not evidence that the core engine is failing. Even so, investors should watch whether those front-loaded expenditures translate into revenue, utilization, and sustained margins. IIJ's next phase rests on 3 connected opportunities. First, generative AI raises demand for graphics processing cloud and data center capacity. Second, government digitalization, cybersecurity, and economic security policy favor trusted domestic infrastructure. Third, full MVNO capability can extend the network into corporate Internet of Things deployments. The bottlenecks are equally concrete: power, engineering talent, build-out execution, and whether expensive new capacity reaches attractive utilization. Valuation is the weakest part of the scorecard. IIJ's forward earnings multiple sits near the top of the Japanese systems integration peer range, while its price-to-book ratio also reflects strong expected returns. The premium can be justified if double-digit growth continues and the operating margin holds near 10%. But if capital spending rises faster than utilization, or hyperscaler competition pressures pricing, the starting multiple offers limited protection. The report's author estimated 3-year scenarios span a wide range. The bear case is roughly 30% below the reference price, the base case about 22% above it, and the bull case around 74% higher. These are not forecasts or price targets. They show how sensitive the valuation is to a few watchable variables: growth, operating margin, capacity utilization, and the multiple investors are willing to pay. In summary, IIJ is a structurally unusual Japanese infrastructure company, independent, vertically integrated, and deeply embedded in mission-critical customer systems. The report scores it 15 out of 20, with top marks for growth and macro fit, and the weakest score for value. The indicators to watch are double-digit revenue growth, the roughly 10% operating margin, returns on the current investment cycle, and utilization of new GPU cloud and data center capacity. This is background research, not investment advice. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.